So let's look at payroll tax. Now, payroll tax is a tax levied on businesses based on their salaries and wages expense. The calculation of payroll tax is usually based on a minimum threshold of salaries and wages expense, including on-costs such as superannuation or retirement contributions. Now, when we first bring in your historical payroll tax information into your financial model from your accounting package, we bring in your historical payroll tax expense into your historical income statement, located above your operating expenditure information and below your movement in long service leave provision. You can see we have our line of payroll tax with the historical tax expense on the right-hand side of the sheet here. Now, we also bring in your historical payroll tax payable balance into your historical balance sheet, and this is located within your employment payables section within your current liabilities. You can see here that we have our payroll tax payable line item with the historical balance spanning the right-hand side of the sheet, and if we scroll across our time series until we get to our last historical month of June 22, we can see that we have a closing payroll tax payable balance of 4.9. Now, when we forecast your payroll tax, this is located at the top of your taxation sheet. Looking at our analysis, we can see that we have our opening balance of 4.9 being brought through from our historical balance sheet. And the first assumption is the delay on when we'll pay off this opening balance within our forecasts, with the delay currently set to 1 month. We also have the assumption of what proportion of this balance will be paid, currently set to 100%. This means that in our first forecast month, being July 22, the entire opening balance of 4.9 will be paid off. If we have an assumption of less than 100%, the residual balance will then be paid off 1 period later than the initial payment. Now, when we forecast our payroll tax, we can see that we're bringing in our monthly salaries and wages expense inclusive of superannuation or retirement contributions. We have an assumption to make any adjustments to this amount, for example, to strip out any salaries and wages which may be exempt from payroll tax. This adjustment then gives us a replicable monthly salaries and wages expense to use in our payroll tax calculations. We can then also set our payroll tax year end, currently set to June. Now, in calculating our payroll tax expense, our next assumption is then the annual deduction threshold. This is the threshold over which you must pay your payroll tax. As you can see, we currently have an annual deduction threshold of $650,000, and we can update this assumption by simply writing over the top if we had, for example, a $600,000 annual deduction threshold. We can then choose the basis on which we allocate this annual deduction within the payroll tax year, either using months or days to determine the split across the 12-month period. This is currently set to months, which means that we take our $600,000 annual deduction threshold and spread that evenly across the 12 months, or apply a $50,000 deduction per period. This means that in the case of July 22, we have our applicable monthly salaries and wages of 152.6, and as this model is in thousands, this means we have an applicable monthly salaries and wages expense of $156,200. If we then apply our $50,000 monthly allocation of the annual threshold deduction, we then have a post-deduction monthly salaries and wages expense of $106,200. It is then to this post-deduction monthly salaries and wages expense that we apply our payroll tax rate to. That is, for the month of July 22, when we calculate our payroll tax expense, we take our 156.2 of salaries and wages expense with any adjustments, subtracting our $50,000 monthly deduction, giving us a post-deduction salaries and wages expense of $106,000, and then applying our payroll tax rate, giving us our tax expense of 5.2 for the month. This is summarized at the bottom of our analysis when we look at our payroll tax payable balance. Looking at the month of July, we can see that we have our opening balance of 4.9, which is increased by our 5.2 of payroll tax expense, which is calculated for the period, less the payment made for the 4.9 of our opening balance, giving us our closing balance of 5.2. As we are also assuming a 1 month delay on the payment of the tax expense, the 5.2 of payroll tax expense calculated within the month of July is then subsequently paid off in the following month of August 22. Now, in looking at the financial statement impacts of payroll tax within a three-way financial model, payroll tax is included within our net operating expenses section of our income statement. This decreases our net profit after tax and therefore decreases total equity on the balance sheet. Payroll tax that is paid in cash is included within the cash payments in our operating section of the cash flow statement, and any payroll tax which is not yet paid in cash, we adjust for in our payroll tax payable balance within the current liabilities section of our balance sheet. The adjustment to our total liabilities ensures that our net assets reconciles with our total equity and our balance sheet is balanced at all times. Hopping back into our example, we can see that in our first forecast month of July 22, we had a calculated payroll tax expense of 5.2, payroll tax paid of 4.9, leaving us with a closing balance of 5.2, and in the following month of August 22, we then have a payment of 5.2 being made for July's closing payroll tax payable. If we want to see the impact of our payroll tax on the financial statements within our model, we can head back to our table of contents and activate the financial statements. Firstly, looking at the income statement, if we expand our net operating expenses section, we can see we have our payroll tax expense, and if we scroll across our time series until our first forecast month of July 22, we can see that we have our calculated payroll tax expense of 5.2 hitting our income statement. Then scrolling down to our balance sheet, if we expand our employment payables section within our current liabilities, we can see that we have our payroll payroll tax payable balance, with a closing balance of 5.2 at the end of the July 22 month. Finally, if we scroll down to our cash flow statement and expand our cash payment section, we can see that we have our payroll tax paid line item, and in July 22 we have our payment of 4.9 being made, reflecting the payment of our opening payroll tax payable balance within our first forecast period. And in the next month of August 22, we have a payment for 5.2, representing the calculated payroll tax expense within the previous month of July. Now, in recapping on the financial statement impacts of payroll tax, our payroll tax expense is included within the net operating expenses section of our income statement, which decreases our net profit after tax and decreases total equity on the balance sheet. Payroll tax paid in cash is included within the cash payments within our operating section of our cash flow statement, and we adjust for any outstanding payroll tax which is yet to be paid in cash within our payroll tax payable balance within the current liability section of our balance sheet. These three impacts ensure that we reflect the payroll tax expense to a business, as well as any payment timing differences between when a payroll tax expense is incurred and when it is paid in cash. This is how we ensure that our balance sheet is always balanced within our three-way financial model.